On April 20th, 2020, you could buy oil. You could buy a barrel of crude, the lifeblood of the global economy, for less than $0. In fact, if you bought it, someone would pay you $37 to take it off their hands. That sentence should not be possible, but it happened. Fast forward to today, March 2026. Crude oil is trading above $120 a barrel. The Strait of Hormuz, a strip of water just 33 kilometers wide, is now a war zone. And the difference between those two numbers, from -37 to +120, is not just a market story. It is the story of everything: war, inflation, recession, and the fragility of the world we built on oil. This is that story. To understand where we are today, you have to go back to one of the strangest days in the history of capitalism. It was April 2020. The world was in lockdown. Factories were silent. Planes were grounded. Cars sat still. Global oil demand had collapsed by almost 30% in a matter of weeks, something that had never happened before in recorded history. But here is the problem nobody talks about. You can stop using oil, but you cannot simply stop producing it overnight. Turning off an oil well is not like flipping a light switch. It takes weeks, sometimes months. And while the wells kept pumping, storage tanks began to fill up. In Cushing, Oklahoma, the physical delivery hub for U.S. crude oil, tanks were reaching maximum capacity. And this created a nightmare for anyone holding an oil futures contract set to expire on April 21st. A futures contract is a promise to buy or deliver a specific quantity of physical oil at a specific place, on a specific date. If you hold that contract and it expires, you must take physical delivery of the oil. But where do you put it if every tank is already full? Here is where it gets truly brutal. Thousands of retail investors, on Robinhood in the US, on apps like China's Bank of China investment products, had bought oil contracts thinking they were buying the bargain of the century. Oil at $10, at $5, at $2. Surely it had to bounce back. But on April 20th, as the contract expiry deadline approached and storage hit zero, panic selling kicked in. With nowhere to store the physical oil, sellers were willing to pay buyers to take it. The price printed, -$37.63 per barrel. History had never seen this before, not once. Some retail investors lost their entire account balances in a single afternoon. In China, the Bank of China had to reimburse clients after its oil investment product imploded. But for those few, the traders and companies who had secured physical storage, April 20th was the best day of their financial lives. They were paid to take oil. Then they sold it months later at $40, $50, $60 a barrel. One man's catastrophe is always another man's fortune. Now we need to talk about a strip of water that most people couldn't find on a map, but that every government, every central bank, and every major corporation in the world watches with extreme anxiety: the Strait of Hormuz. 33 kilometers at its narrowest point, 2 shipping lanes, one in each direction, each just 3 kilometers wide. Through those lanes passes roughly 20% of the world's oil supply every single day. 20%. Saudi Arabia, Iraq, Kuwait, UAE, Iran itself. All of them export their oil through this bottleneck. In March 2026, this strait became a front line. Following the escalation of hostilities between Iran, Israel, and U.S. forces, Iran began targeting commercial shipping in the Gulf. 4 tankers were struck in the opening weeks of the conflict. Insurance rates for vessels attempting to pass through Hormuz skyrocketed by over 300%. Many shipping companies simply refused to send their vessels at all, and the market reacted with immediate, visceral terror. Crude oil, which had started 2026 at around $61 a barrel, surged past $100, then $110, then touched $120 within 10 days of the conflict escalating. Goldman Sachs issued an emergency note warning prices could go higher still if disruptions continued. Analysts who had forecast a global oil surplus of 3 million barrels per day for 2026 were now looking at a deficit of nearly 20 million barrels per day. Let that sink in. A swing of 23 million barrels per day in the expected supply-demand balance. This is not a blip. This is a structural shock. Here is what most news coverage misses. An oil shock is not just about the price of petrol at the pump, though that matters enormously to ordinary families. Oil is embedded in the price of almost everything: plastics, fertilizers, chemicals, transportation costs, heating, electricity generation. When oil spikes by 80%, 90%, 100%, those cost increases ripple through every supply chain on Earth. Scenario 1: inflation returns, and the central banks are trapped. Heading into 2026, the Federal Reserve, the ECB, and the Bank of England had finally, carefully, begun cutting interest rates. Inflation had been beaten, or so everyone thought. Now an oil shock of this magnitude risks reigniting inflation globally, just as central banks were easing policy. If they raise rates to fight oil-driven inflation, they risk tipping already fragile economies into recession. If they hold rates and do nothing, inflation could become entrenched again. There is no clean answer, and that paralysis is itself dangerous. Scenario 2: Asia gets hit hardest. China, Japan, South Korea, and India are among the world's largest oil importers, and they source the majority of that oil from the Persian Gulf. If the Strait of Hormuz remains disrupted, these nations face a choice: pay dramatically higher prices or find alternative sources that don't fully exist. China's manufacturing base, still the engine of global production, would face severe cost pressures. The goods that flow from China's factories to every Walmart and Amazon warehouse in the West would become significantly more expensive. This is not abstract geopolitics. This is the price of your television, your sofa, your children's toys. Scenario 3: the stagflation nightmare. The most feared economic scenario of all is stagflation, rising prices combined with a contracting economy. It happened once before at scale, in the 1970s, when Arab oil embargoes sent the world into a decade of economic misery. If oil stays elevated, inflation rises, central banks are paralyzed, demand collapses, and growth stalls. You have all the ingredients for a rerun of the 1970s. And unlike in the 1970s, governments today are carrying record levels of debt. Their ability to absorb and respond to this kind of shock is severely limited. Every crisis creates winners and losers. This one is no different. The winners. Russia, despite being under sanctions, has rerouted its oil exports to willing buyers and benefits from every dollar oil rises above $60. Norway, Canada, and the United States, which now produces more oil than any nation in history, all see their energy sectors explode in profitability. The oil majors, Shell, ExxonMobil, BP, Total Energies, will post record profits while ordinary consumers suffer. Gold, which your channel has already covered extensively, continues to benefit as oil-driven inflation makes real assets more attractive. The losers. Emerging markets are being devastated. Nations like Pakistan, Sri Lanka, Egypt, and many sub-Saharan African countries import nearly all of their oil. They pay in US dollars. As oil prices rise and the dollar strengthens on safe haven flows, these countries face a double squeeze, paying more for energy in a currency they are running out of. Some economists are already warning of sovereign debt crises in the most vulnerable nations, and ordinary citizens in those countries, who had nothing to do with a war in the Persian Gulf, will pay the highest price of all. In 2020, oil cost less than nothing because the world stopped. In 2026, oil threatens to break everything because the world cannot stop needing it, cannot stop fighting over it, and cannot stop building an economy around it. The distance between those two moments, from -37 to +120, is not just a price chart. It is a measure of how fragile, how interconnected, and how dependent on this one black liquid our entire civilization remains. We had 5 years to change that. We did not change it nearly fast enough. And now, as missiles fly over one of the most critical waterways on Earth, the bill for that failure is arriving. The question is not whether the world economy will feel this shock. The question is how long it lasts, and how many people pay for it. If you found this analysis valuable, subscribe to Market Narratives. Every video we make asks the same question: what is really happening in the global economy? And what does it mean for you? We'll see you in the next one.